When the market is very volatile, it pays to trade options, but you have to know exactly how to do it or you'll get crushed. In this video, our head of options trading will help you avoid the costly dangers while guiding you step by step on how to do it right. I'm Mike Bellafiore, and we're a long-standing proprietary trading firm located in New York City since 2005, and now Miami as well, and proud to develop numerous consistently profitable traders. Watch, take notes, and learn from the team at our prop firm so you can grow your trading account.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. As I'm sure you're aware, out of nowhere on Monday morning of this week, a company located in China created an artificial intelligence app known as DeepSeek, which has shaken up the tech world, causing the financial markets to panic over the question of whether DeepSeek's substantially cheaper training costs will have a potentially devastating impact on computing power requirements moving forward. And as a result, we all awoke Monday morning to a rude awakening with the index futures down about 2 to 4% in a market that was looking almost unstoppable the week before. And so it's natural during extraordinary down moves like we witnessed on Monday for traders to ask themselves, what would be a trade that I could implement on a morning like this, and exactly how would I execute that trade? And so that's the topic of today's video, a playbook for mornings where the market is basically crashing. Before we get into the options strategy that we're going to be teaching you in today's video, if you're brand new to options trading and you don't know much about how options work, we put together a video, a free YouTube video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the option strategy that we're going to be sharing with you in today's video. Then when you're finished, you can come back and watch the rest of this video. To illustrate an example of a trade that has lots of advantages in crashing markets, let's go back to December 18th, which was the date of the last Fed meeting. And you might recall that during the Fed press conference that day, Fed Chairman Powell spooked the markets by casting some doubt on the pace and magnitude of further interest rate reductions in the new year, which the market was counting on. And so that had a obviously chilling effect on the market that day, which basically crashed right into the close based on his comments, selling off from its opening price of 60.47 all the way down to 58.72, off more than 178 points on that day, close to a 3% drop in a single day, closing right around that support area of 50.8075, which had held up since early November. It's also important to note that on that same day, the VIX, the CBOE Market Volatility Index, which basically measures how much options prices are pumped up by the volatility in the prices of the stocks comprising the index, the VIX index skyrocketed that day, up 74%. So let's take a look at what would have happened at the end of that day, December 18th, had we pulled up an options chain expiring a month later on January 17th, and we scrolled down to the 5,700 put strike price and sold two of those puts for 70.35 while simultaneously buying two puts 50 points below that at 56.50 for protection. And on that one, we paid a price of 61.55. Now, when a trader sells a put higher up on an options chain and simultaneously buys a put lower down on that same options chain, he has just entered what options traders call a put credit spread trade. And to understand how this trade works, let's start by breaking down its cash flow. And so starting with those two puts we sold at 5,700, we received a price of 70.35. And remember, each index option pays out $100 per point that the index closes below that put strike price on expiration day. And so you multiply that price by 100 and you sold two of them. And so multiplying it all together, you end up with $14,070 in cash inflow from selling that option. But then you turn right around and spend a lot of that cash flow on protection, buying those two puts at 56.50 for 61.55, which, as you can see, results in a net positive cash flow of $1,760 for selling this put credit spread that afternoon. I also want you to focus on the fact that your broker is going to require you to have $8,240 in capital in your account for this trade, which is the trade's worst case scenario. If we move to January 17th, 2025, the day the put credit spread expired, you can see that the index ultimately rallied compared to the trade entry price back in December, closing at 59.66 that afternoon. And now, since both of these options have expired, we can assign a final value to them, which is going to be pretty straightforward because after taking into consideration the original 1760 in cash flow that we received at the start of the trade, you'll notice that both the short puts at 5,700 and the long puts at 5,650 both expired worthless, being so far below where the index expired. And so we simply keep the cash we first received, that 1760, as our trade profit, which means we received a 21% return on our capital in just a month. By contrast, I want to head back to a date about a month before that, November 15th, 2024. And you'll note that the index closed at 58.70 that day, which is almost exactly where it closed in that December example that we just showed you. But you'll notice that the red down candle on SPX is much smaller than the red candle on the Fed sell-off in December, where the index closed down only about 79 points that day, whereas the index was down 178 points in the December example. And so when you turn to the VIX that day, you can see that the VIX had a very minor increase, moving from 1431 that day before to 1614 on November 15th, which is important to keep in mind as we move forward here. And that makes sense in light of the fact that the sell-off was so much less severe. And so let's do the exact same trade, just taking place 1 month earlier, finding an options chain about a month out, in this case, the December 16th options chain, selling again 2 of the 5,700 puts and buying 2 of the 5,650 puts, exactly like we did last time, and almost exactly as far below the market as last time. And so we're really about as apples as you can get, but this time our options prices are very different. The short 5,700 puts are selling for $33.75, and the long 5,650 puts cost $27.30. And so when you look at the cash flow, you'll notice that when you deduct the $54.60 cost of the protective 5,650 puts out of the positive cash flow from selling the 5,700 puts for $67.50, you end up collecting much less net cash flow, $470 less to be exact. And in addition, the trade's going to require more capital. $470 more in capital is required because you collected $470 less for entering into the trade. And so your broker is going to require 5.7% more capital on the trade, adding insult to injury, which means that your worst case scenario on the trade goes up even though you collected less premium, which, as you saw from the January expiring example, often translates into your exact reward for this trade. So less potential reward for more risk on this trade. And so when you move forward to the day the trade expires, December 16th, you'll see that the index closed up quite a bit from the day we initiated the trade, closing at 674.08. And so when we look at the trade outcome, you can see that again, both of the puts expired well below the index closing price and are therefore worthless at expiration. And again, the cash flow of $12.90 becomes our profit. This time with a much lower return of 14.8% because of a combination of that lower initial positive cash flow and the higher initial capital requirements. And so the inescapable conclusion is that you're generally going to be better off selling put credit spreads in a high volatility environment, as you can see from this comparison. In a higher volatility environment, when the VIX is comparatively higher, your initial cash flow is better, your capital requirement is lower, and thus your return can be much better on less risk, ironically. And so what I'd like you to take away from today's video is that thoughtfully selling put credit spreads into a high volatility environment can be a very rewarding practice compared to more normal environments, as long as you have a reason to believe that a bounce is possible based on a sensible rationale, such as we had in this case where we were expecting the markets to bounce off of a pretty clearly defined support area. Professional options traders are always seeking these kinds of opportunities that have edge, and as a retail trader, let me say that again. Professional options traders are always seeking these kinds of opportunities that have edge. And as a retail options trader, these opportunities are available to you as well.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.